Hey everybody, welcome to Navigating Real Estate Turbulence. I'm John Lafferty with Century 21 Town & Country.
And I am Tony Abate with Ross Mortgage.
Tony, so today we're talking about something that appears to be coming down the pike. And it's the big elephant out there that people are kind of talking about but not talking about, forbearance.
Yeah.
So this is something that started last year because of COVID. Mm-hmm. The government actually put it in place to help people who could not continue to pay their mortgage and wouldn't be in danger of losing their home.
Right.
And so here we are almost a year later, and where does everything stand? Where are things at? What are the numbers that we're looking at? You kind of just give us a little bit of an overview.
Yeah, John, thanks. So this is probably a great example of good intentions with unintended consequences. So when it was clear that the pandemic was going to have substantial impact on people's jobs and the economy and so on, the CARES Act was signed into law. That was March 27th of 2020 last year. CARES Act went into play, covered a lot of different categories, one of which allowed people to request a forbearance on their mortgage. Forbearance meaning that because of economic impact, that a person didn't have to make their house payments. And the interesting thing in this case, well, let me back up a step. Normally, when there's a request for a forbearance, one of the requirements is you have to show cause. Why do you need this pause in making the house payment? Well, the conclusion was that because things were happening so quickly during the pandemic, the idea was we're not going to make anybody show a burden of proof with regard to requesting the mortgage forbearance. And the unfortunate part of that is that there is and always will be a subset of people that, given the opportunity to not make a house payment, they're going to choose to not make their house payment, whether or not they were impacted by the pandemic. So that went into play. Many people, and of course many legitimately requested the mortgage forbearance, and then they didn't have to make their house payment. Under the Trump administration, it was first put into place for 6 months, then another 6 months, and then comes the Biden administration. They extended it for yet another 6 months, and now we're up to 18 months of forbearance, and there is substantial talk on the table that it's gonna probably push out another 6 months. So collectively, we're talking a 2-year window of time where homeowners could be in their home and not have to make a house payment. And for those that have had substantial impact due to the pandemic, that's important relief. For many others, it's 2 years of not making a house payment and nothing more. But the danger here is twofold. There's a number of things actually. Number one, it can't go on forever, right? Number two, the regulating body of all this, which is the CFPB, the Consumer Financial Protection Bureau, has basically said to the mortgage industry, now look, there's going to be a lot of people that are going to be in rough shape at the end of this, and you need to make sure that they're taken care of properly. And then they stepped back. And that was pretty much all they did. So they were the first one to kick the can down the road further, and so there's going to be some difficult outcomes with all of this because again, forbearance is not forgiveness. These suspended payments have to be eventually made up, and there's a few different mechanisms in which that can be done.
Okay, so pull out your crystal ball and look 6 months or a year down the road when the government at some point says, okay, we've pushed this out long enough, lenders need to start collecting money again. What does that look like? Do you see a mandate that says, hey, guess what? The only thing that you lenders can do is take all those missed payments and just put it on the back end. Mm-hmm. You can't demand a lump sum payment. You can't demand half up front to continue going. You have to put it on the back end. Do you see something like that happening and that probably helping a lot of people? Or do you think it's just going to be, hey, lenders, do whatever you need to do.
Yeah, John, there's a few safeguards in place that are appropriate. So folks that are in forbearance right now, what they won't have to do is make a lump sum repayment of the unpaid payments when they come out of forbearance. And there was a lot of fear and concern over that. So that's a given, and that's pretty much regardless of the loan type. So your conventional loans, FHA, VA loans, rural development, there's not a lump sum requirement. The door's open. The servicer will gladly take that money if the consumer can do so, but that won't happen. The other thing that's not happening is during the forbearance period, the servicers are not supposed to be putting any sort of derogatory entry on a person's credit report.
Now, didn't that happen in the beginning, though?
Yeah.
They were putting derogatories on people's credit, and what stopped that?
Well, I'm not so sure it stopped entirely, to be quite honest with you, but there was some, because of things happening quickly during the CARES Act, what would end up happening is that they wouldn't put a derogatory entry, but they would put a notation on the trade line that said the loan was in forbearance. So now comes the next creditor, they pull that credit report and they see a mortgage that is payments not being made, and they're saying, well, you know what, we're going to treat that as a derogatory entry. So it did create some noise surrounding that, and so they didn't log late payments necessarily, but they did put that notation in.
Can you? Sorry, I don't mean to interrupt you,
No,
but
that's right.
but I'm just screaming in my brain. Can you equate those two then? If you've got a forbearance a notation on the loan, and somebody decides, oh my God, interest rates. Last year, interest rates are at 2.9%. I'm going to refinance, and they've got that notation there. Is it a no way, not taking that risk?
It was for a while, or at least it made it very difficult for that consumer to refinance. But now what a consumer has to do if they do want to refinance is that loan's got to be brought current. Okay? So a refinance with most loan types can't be used as a tool to cure a forbearance. Okay? So there is some legitimacy as to why there should be a notation out there for the loan being in forbearance, but it can't be something that triggers late payments or have a negative impact on score, for instance. But it's out there, so it is known when that happens. So now comes the end period, and this is where it gets a little messy because we'll have some extensions. Foreclosure moratorium is right now slated through June of this year, but at the end of the day, when the forbearances come to an end, you're going to have folks that fall into a few different categories. You're going to have folks that are still negatively impacted by the pandemic who still just can't pay. You're going to have folks that could pay, but now things have changed on their loan because they've got to do something with this unpaid portion of the loan. And then you have folks that are just going to be able to manage through whatever changes they have to do on their loan. But where there is great concern, and the CFPB, I will tell you, is very concerned about what could be a great number of foreclosures that happens later this year, is the fact that people are going to cycle out of forbearance and either they're not going to be prepared to start making payments again, or they're not going to be prepared to manage the choices that are available to them through a forbearance. And here's what those choices look like, and this is what's on the Fannie Mae website right now. So a person can opt for a reinstatement at the end of the forbearance, and reinstatement simply says, here's what you owe, pay this amount, send us a check, and then you're back to square one. So I don't think most will opt for that, but that's an option. There is a second option that is generically called repayment. But what the repayment calls for is to take the unpaid portion and pay it out over 12 months. I've got some math examples, and that's probably something that on the surface sounds reasonable, but from a budget standpoint can be a little tricky. Another option is called the COVID-19 option, and that's literally where they'll take that balance and they'll put it on the back end of the loan to be paid at the time that the home is sold or when the loan is refinanced. Now, that's probably going to be the option that a large number of folks that are in forbearance take, But the expectation from the way that the Fannie Mae website reads is that that option is available to you if the first two options are unmanageable for you as a consumer. So it's not just that it doesn't sound like it's going to be a matter of just checking the boxes saying, tack it on the tail end. It sounds like a person's going to have to be able to demonstrate that they cannot do the repayment option or the reinstatement option, and then it can be tacked on the tail end. At the end of the day, it's still a ding to their equity, isn't it? Because it's the balance is still there, and then nothing was paid down. And then the last option, and this is the one that's probably going to be the most damaging, but it is an option. And it's damaging because it would be viewed as a derogatory credit event, and that is they could have the loan modified so that the new overall principal balance is maybe recast over a different term, different rate. There might be some push downs of principal balance. I don't think that's going to happen. That was suggested during the last recession, and it almost never happened. But those are that would be the last option that a servicer would permit.
Let's take a walk down memory lane,
Sure.
And let's just compare and contrast this time, this period, because I've heard people talk out there, pundits, other experts. Apparently, the guy who predicted the 2008 bubble is also predicting another bubble here. Let's talk about why this time is different than 2008. And there's so many differences, so many other reasons why we are where we are, and just sort of do a compare and contrast.
Sure.
Of what you and I both went through at that time.
Right. Yeah. I'm glad you brought that up because I think there's some dramatic differences between the two circumstances, and I'm going to, I probably don't have the flowery degrees that the individual has that predicted the last bubble and is predicting this one, but I'm going to disagree, and I'm going to say that we're not going to have a similar bubble as we had in 2008. There's a couple things. So the first one happened. There were a variety of reasons, but for the purpose of our conversation, it was really because of laxness and an overabundance of available credit, right? And so the characteristic that existed then that doesn't exist now is that there were a large number of homeowners that were just flat out over encumbered, right? And so you couple that with economic downturn at that time that caused property values to drop, and it made the situation worse. And so you've got a decades-long situation where consumers in their mind could be thinking, all right, if everything financially hits the fan, I could always sell my home. And during the last recession, that option was taken away. They couldn't sell their home because they were upside down. Their loan balance is greater than the home value. We're in a completely different place now, right? Home values have gone up substantially. There's demand for homes. The current crop of homeowners is really healthy financially, right? They made prudent decisions when they took out their mortgages over the last 10 years or so. They didn't go to the wall. They didn't have the tools to over-encumber their home. And we've seen nice, healthy appreciation in the real estate market. So I would say it's an entirely different circumstance. And the foreclosures, in my view, that are being predicted by the CFPB are more of a function of almost like a technical aberration of what's happening on the tail end of the forbearance, as opposed to a complete global economic meltdown like happened in the last recession.
In 2000, the lead up to 2008, 2005, 6, 7. People were using their homes as ATMs.
Oh, goodness, yeah.
They were, I think I've shared this example before, but I have to go back to it because the guy was incredible. So, guy that I knew bought a home. This is probably 2005. Bought a home for, let's say, $800,000. And at that time, the market was increasing every month in 04, 05, 06, every couple months. It was like you made 10 grand on a house of that expense. So he pays $800,000 for this house. And as you know, when you finance, your first payment is usually a couple months out for them to get everything going, depending on when it closes. So he buys this home, and before he makes his first payment, decides he needs to refinance again. He refinances a second time, pulls some equity out. Couple months go by again. He takes a second out on the house, pulls more equity out, and then a couple months go by after that. He refinances both loans again and pulls more equity out. So he did this for about 6 or 7 months, never made a payment, not once. And by the time 2007 rolls around, he's going into foreclosure because he can't make a payment. And then it took him a while to throw him out. But that was just kind of the mentality then of people using their homes as ATM, is just, I'll just refinance, pull cash out, and buy that new car I always wanted. I'll just refinance, pull cash out, we'll take that family vacation we always wanted. And that was the mentality because prices were going up so high. Every 6 months, your house was going up. $10,000, $15,000, $20,000. Why should I leave that money in the house? It's not doing anything. Pull it out, use it. And that was happening a lot. And then couple that with, hey, stated income, stated assets. We're going to finance you for up to 103% of the purchase price of the home. There was a lot going on. So let's contrast then with where we are now, which is with what you've noticed in buyers and what I've noticed in buyers is they're putting substantial skin in the game in down payments. These younger buyers that are out there, the 20s and 30-year-old buyers, they're doing 10, 15, 20% down. They're in a better financial position. They're limiting themselves. They may be approved for $350,000, but they don't want to go past $280 because they got a budget that they want to live within. It's pretty incredible to see how disciplined they are, and the other factor too that I think you were kind of alluding to is most of these homeowners who are in forbearance, they have equity in these homes. So even if the worst case scenario is they have to sell, they're going to walk away with money, which is a different position than the people in 2008, 9, 10, 11, 12 were in. They were sometimes having to bring money to the table, or it was being foreclosed on and they were going to lose money. At least these people have money, and even if they're foreclosed on, if they're in Michigan, they have the redemption period that they can still sell the home, pay off the bank and any other costs, and still walk away with equity. So that's the difference. Sorry, taking a walk down memory lane. So
it is different,
To circle back to your math, some numbers that you had, some examples. I'm curious to see sort of how things flush out.
So this is going to be this is going to be visible and noticeable in our market for sure. Right now, or not right now, but in January of this year, there were 2.7 million homeowners that were in forbearance, and by September of this year, 1.7 million of them are scheduled to come out of forbearance, and so we're talking about a substantial number of homeowners. And the reason that there's a disconnect is like, well, how come it's not 2.7 million homeowners coming out? Is that not everybody applied for forbearance at the same time, right? Some homeowners who try to stick it out for a while say, my goodness, my hours were cut, I didn't come back, I got to go to forbearance. And so there was some staggering of these dates. But when we're talking 2.7 million homeowners that are in forbearance, that's 5.5% of everybody that has a mortgage, which is really high from a percentage standpoint. So let's look at a scenario. So let's say somebody took out a mortgage in 2016 and it was for $250,000. They got an interest rate 4.25%. Their monthly loan payment is $1,230 a month. Now comes the forbearance. Now comes the pandemic, and in May they opt to request a forbearance, May of 2020. And then they are scheduled to exit that forbearance this coming September of 21. So mathematically, they will have missed over $20,000 in house payments. Okay. Now comes their options. What do I do? Well, reinstatement, write a check for $20,000 to get back on track. Most consumers are not necessarily going to be aligned to do that sort of thing. The repayment option, where they can make that up over a 12-month period, that's their normal monthly payment of $1,230 per month plus $1,742 per month. That's a big chunk of change for somebody who has not been making a house payment for the previous 18 months. You talk about payment shock. That's a big deal. So these are some of the things that the CFPB is concerned about that are going to lead to some people saying, I just can't do it. I just can't do it. So going back to what you said earlier, and that leaves that safety valve option open, where that consumer can say, it's time for me to sell the house. And so hopefully, and I think this is where maybe the real estate community comes in to help educate and give some guidance to the consumer, instead of getting to that point where there's foreclosure conversation and we get back into the scenario where there's the homes that are abandoned, homes that are neglected, and so on. They can make a different decision and say, you know what, I do have that equity. Let's put this darn thing on the market if I can't manage the payment. And goodness knows there's buyers out there that are ready to buy those payments. Now that's a little bit of tough love. There's no doubt about it. But that's the conversation that I think we need to be having with consumers. Is there's a great deal of prediction about foreclosures coming down the pike on the tail end of forbearance. But I think that before homeowners get to that point, they need to reach out to people like you and say, all right, I don't like the looks of things coming out of forbearance with regard to what my expense would be. And I'll go back to what I said earlier. Consumers are all over the spectrum as far as where they're at financially. If they're going to come out of forbearance and they're still at 70% of pay, or if they're in the service industry where they're working at a restaurant that is still clinging to 50% occupancy, they simply may not be able to afford it. Well, the worst thing they can do is stick their head in the sand, right? And so have that conversation with you. They may be pleasantly surprised as to what they could sell their home for. And if they have that conversation early enough to where their credit's not damaged, they can still buy another home, maybe one that's more of an appropriate size for where their finances are at the time. That, too, is a very different element from where we were in the prior recession. Those are options that just were not on the table. We were teaching people how to manage through short sales back then. And now I think the message is going to be, don't walk away from all this equity that you've built in your home, because your new payment terms are appearing to be unmanageable. The other thing that can happen from the lending perspective is that if they have that mechanism to bring that foreclosure current, then let's take a look at a refinance of the debt. If we can basically do a refinance, rates are still very, very attractive. And now what are we doing? We're recasting that loan over a new 30-year period at low rates, and the credit report won't say modification on it. So if that makes it affordable, that's another option too. So the huge fork in the road compared to 2008 is consumers are going to have some options, but they can't stick their head in the sand and just ignore the correspondence, ignore the news that they're seeing, and so on. They got to take some action to prevent this to prevent bad things happening to them as a homeowner.
It's true, and we dealt with that a lot in the prior recession. That people, it was amazing the people that you would come across who would say, "I know our home is being foreclosed on, but we're going to leave it in God's hands." And I would say, "What does that mean?" Mm-hmm. "I don't know, but we're just gonna go with that." Say, okay. I don't know how to help that. I don't know what to do with that. But a lot of people were angry and destroyed a lot of homes and did a lot of damage to them. And in this instance, there are going to be people that are going to lose their home, but you're right that maybe it helps in a weird way contribute to solving the undersupply. Obviously some states are going to get hit worse by others, but it'll help, I think, somewhat. We just don't know when it's going to happen. Is it going to be June? Probably not. Is it going to be December of this year? Probably not. Is it going to be 2022 that they finally let it happen? In an election year? Probably not. My sense is we have to be on the other side of of this pandemic, where people are working and kind of getting some semblance back to normality and being able to do different things. My sense is at that point is probably when they pull the trigger and don't extend. I mean, what do you think?
Well, I think there's some realities there. There's already talk of they're looking at the calendar of when extensions will come and go, and they're saying, "My goodness, right before Christmas? No, we're not going to do that."
Yeah.
And so you're right. There's always going to be something on the horizon. But there's an interesting mechanical thing behind this, and that is the fact that while payments aren't coming in, the investors that buy mortgage-backed securities are still expecting to get their yield. They're expecting to get their monthly payment.
Yeah.
And so what ends up happening? Water is going to seek its own level. The cost of borrowing is going to be impacted if servicers, and we're talking all the way to Fannie Mae and Freddie Mac, really, because they're the owners of these notes, if they have to keep spending money to keep the investors whole, but there's not payments coming in, there's only one way to fill that void, and that is charge the new people more.
Yeah.
Right, so we'll see. I try to stay out of the arena of predicting what the cost of borrowing is going to be. But I think if they keep kicking this can down the road, then that part of that is going to lead to potential higher costs for borrowing.
Yeah, you can totally see that.
Yeah. So.
Well, thanks
anyway.
for sharing that, Tony. This is an interesting topic, and we're all going to be dealing with it at some point here in the near future. But for the time being, I guess we're just status quo.
Absolutely. All right. Thanks very much, everybody.
Thanks, everybody, for listening.